I'm going to talk a little bit about the economy and the backdrop which the construction industry is operating in. So what's the environment like? So let me start with a couple of graphs and the usual metrics when we talk about the Irish economy, our headline indicators, GDP, GNP, these are the standard measures. What's the economy doing? These graphs go back to 2007 up to 2017, so it's a time series of data for the last couple of years, a very turbulent period where we've gone from boom to bust to recovery to now being back above peak again. You can see the strength of the recovery that's come through. And of course, we know that with some of these measures, there are things going on. They are affected by globalization and different things. But when we strip these out, we still see that the economy is growing at a very healthy pace. So as a starting point for a sector that's trying to operate, it's good that the base economy in which it's operating in is growing again. We see a similar picture coming through if we look at kind of more timely indicators of the economy. And one we do in Bank of Ireland is a survey each month where we talk to 1,000 households and 2,000 businesses, 250 of which are in the construction sector. And we ask them for their views on the economy, on their finances, how they think things are developing, on their views on house prices, on their business prospects, are they going to hire and so on. And we amalgamate it all together into effectively a timely sentiment indicator of how households and firms are feeling. This shows you the picture back to January 2016 when we first started collecting the data. Over that period, it has been very turbulent as well, and you see in the graph there, in July 2016, for example, there is a big fall in sentiment in the wake of the Brexit vote. It recovers a little bit, then we get to another very sharp fall there in November 2016 when we had the outcome of the US election. So we can see how developments are feeding through and impacting sentiment. Since then, there's been a bit of stabilization, and in the most recent data, sentiment picking up again across households and firms. So let's delve a little bit behind that and see what's driving the economy. And I suppose just before that, to make the point, when I talk to a growing economy, to give you a sense of numbers there, our forecast would put the economic growth this year at 4.7 and next year at 3.8 in GDP terms. So that's a very healthy growth rate. It puts us again at the top end of the league table in a euro area context, and it is a very solid rate of growth. So the starting conditions favourable in many respects. But let's look behind those numbers then and get a bit of a sense of what's driving the economy at the moment. And we can split it down into what's happening in terms of consumers and households, how you guys as consumers are feeling. We'll take a little bit of a look at the housing market, and let's take a look at business as well and where things are there. So if we start with the consumer, this again is a graph that we start back there in 2007 up to the most recent data. What you see is that whole period we were talking about, from boom to bust, recovery, and consumer spending now is just above its previous peak. So consumers are back in the picture. For quite a while they were missing. They're now back and they're now spending. And that's very important because they are going to be a key driver of growth going forward, and we put them down as an important driver over the next couple of years. So why are they spending? Generally feeling better, feeling more confident. And this indicator is that survey that we do of 1,000 households each month, where we ask them all those series of questions and we amalgamate it together. And you can see the trend there. It softened over the course of 2016 in the wake of all those events and the political uncertainty that was there. It's been edging up in more recent times, broad upward trend there, and is at quite a high level. So to give you a little bit of sense of what's behind that, what we're seeing now is about 3 and 5 households, around 60% or so, are telling us that they think the economy is going to improve in the next 12 months. 1 in 3 households are telling us that they think their own finances are going to improve in the next 12 months. That improvement in confidence is coming a lot from the fact that the labour market is doing well. the economy is creating jobs. And if you don't like any of the indicators of the economy that are there, the one that is very solid is it creating jobs, and it is doing so. Those jobs has been doing so for quite a while, as you can see in the graph there. It's on a strong upward trajectory. It is interesting that this one hasn't yet gone back to the previous peak. So we haven't yet recovered all of those jobs, but we're nearly there, and we would expect that we will do so over the course of this year. Importantly, with the jobs that are being created, they are being created across all the different sectors of the economy, everything from services, industry, construction, retail, ag. Also, they're being created across the country, and we always have the long-running debate as to whether it's a Dublin-led recovery, whether it's wider. The jobs data is telling us very clearly that the recovery has broadened out to all the regions, and the bulk of the new jobs that are being created now are being created outside of Dublin. So a broad-based recovery, which is very important because we want this to be sustainable. And with those jobs being created, the unemployment rate has started to come down. It's quite marked now. We got to almost 16% in terms of the unemployment rate, which was very, very high. We're now down to 5.9 in the latest numbers. So 10 percentage point turnaround is very, very significant. So you can see as people are going back into work, as unemployment is coming down, that it's natural that that would start to feed into a bit more positivity about the economy. We're also starting to see some growth in terms of earnings, and that's of course helping people with positivity in terms of their own finances and whether things are going to looking up on that front. This is the data from the CSO, and there's been a pickup there. In our surveys that we do, and the one we just did in April there, we asked firms around the country as to whether they planned on increasing pay over the coming 12 months. About 36% of them indicated that they were going to do so. About 3.6 on average was the pay increase that they were looking at. For the construction sector, that was a little bit higher, more around the 4% mark, reflecting a little bit of the shortages of skills that are in the industry, and we'll touch on that in a minute. So earnings are starting to pick up. Firms are indicating that there's going to be some pay increases in prospect, so people are a little bit more confident about their finances. Also helping the consumer picture is the fact that there is very little inflation. So prices are pretty flat there, and this is something we're seeing in Ireland. We've been seeing it across Europe and the wider global economy for a number of years. Our rate particularly low at the moment, partly because of the pound, and that's pushing down on things. But from a consumer perspective, it means a little bit more bang for your buck. So that's supporting confidence. The interest rate environment also quite low. We have the rates there and the market expectations in terms of the main central banks. We know that in the US, the Fed has started to hike. That cycle is underway as the economy has recovered. In the UK, they've just kick-started, and we expect that there will be more and gradual hikes over the coming period, whereas the ECB still zero, and we don't see any movement in that for a while. So generally a low interest rate environment helping. And likewise, another big game changer for the consumer has been the debt level, and the fact that over the course of the boom, we leveraged up, and this was households, it was firms, it was across the board. There has been a lot of hard work and painful restructuring again across the board to bring those debt levels down over the last number of years, and we can see in the households case that it has been quite significant, going from over 215% in terms of debt to disposable income down to about 140% now. So that story of jobs being created, of earnings picking up, of debt coming down, of supporting factors like low inflation, all helping the consumer feel a bit more positive and translating into them spending. And that spending, is across the board. It was initially around cars, and we've heard a lot about that over the last couple of years, but it's broadened beyond cars as well into things like furniture and electrical goods as the housing market has recovered, and into department stores, into bars, restaurants, and so on. So again, it is quite broad-based, which is important. credit turning as well, which should provide a help going forward. And just for fear that you think consumers are super happy and everyone is jumping up and down, they do obviously have concerns. And we get a list of things in every month that people tell us are they're struggling to deal with or that they're worried about. Typically they're around paying their household bills, they're around the tax burden, and the two that are particularly relevant for the sector here, the cost of renting and rising house prices. So they won't come as no surprise to anyone. But they provide us with a little bit of a segue into taking a look at the next part of the economy. And if we move from the consumer into the broader picture around housing and construction. I think David is coming after me, so I know he's probably going to go into this in more detail. So I'll just touch on a couple of points around the housing and construction sector to give you a feel for what we're seeing and share some of the insights that we have in our pulse data. This is just activity in the construction activity over the last number of years, 2007 up to the most recent data. Just making the point again, you could see the very sharp fall off. You can see that there's been recovery and it's been in growth phase for the last while. Another way of looking at that or seeing if there is something happening is to look at the house completions numbers. Up front, I know again that there's problems with the house completion numbers. We have the ESB ones here. There's different metrics, different ways you can look at this. I'm going to show it as an illustration of the broader point, which was we were at a massively high level during the boom, and on this ESB connections basis, we were building around 90,000 houses. That fell to 8,000 at the down point, the low point, and it's up now to about 20,000. So we've gone from a very high level to a very low level to coming up a little bit. So whatever metric you look at, it'll show you the same type of story. We're coming from a low base. Building is starting to happen again, but it is coming from a low base. And we would be estimating that we would need housing units of around 35 to 40,000. We're building 20,000, so we are a long way short of what we need to be building. There's been a lot of discussion around supply and demand, and I'll touch on a couple of the factors. One of the things that has been said is that there's supply constraints and that we're not seeing enough coming through from the sector. So we ask a question every month to the construction industry as to what are the key things impacting, limiting their business activity at that point in time. And here's a couple of them that I'll call out that fairly regularly feature. March and April in particular, weather conditions, no surprise, topped the list between the beast from the east and Storm Emma and all the rest. We have had a particularly difficult period of time, so weather has been a key concern. Shortage of labour, that's coming through for a very long time, and it's very pronounced in the construction sector. Uncertainty is also featuring, and that's uncertainty in a couple of different respects. It's uncertainty around general economic policy, so the obvious one there is Brexit and what that might mean for the Irish economy. It's also uncertainty about sector-specific policies, and if you think of all that happens within the sector, and there is a lot of policy move. The last couple of years we've had the introduction of macro-prudential rules, we've had help to buy schemes, we had a whole discussion, was the help to buy scheme going to be removed, it was staying, was it going to change, and so on. So you see a kind of a reaction to that from builders when they're trying to plan and think. Demand comes up on occasion as well. That could be a little bit linked to Brexit as well, just what might it mean for the economy and for demand going forward. And then financing tends to feature as well, and that particularly relevant in the context that over the last number of years we've obviously had quite a shift in the whole structure, particularly around development financing and moving towards a more debt equity model, whereas would have been all debt in the past. So there's been a change. So again, I don't think any of those things will particularly surprise anyone, but it's useful to be able to track them and see how they're developing. And really, that shortage of labour one, I suppose, is probably the one that is popping out most consistently. On the demand side of things then, we know that there's very strong demand there for a number of reasons. One of those is simply the structure of our population. If you look at the fat arms of the pyramid there, these guys are all the 25 to 40, 49 or so. So essentially the house buying age cohort. There's a big chunk of our population in that house buying age cohort. In addition, we've seen migration turn positive. So for many years, we had a lot of people leaving. In more recent times, we've got people net migration positive, people coming back in again, and potentially a little bit more to come, depending on how Brexit plays out and if we attract some FDI and so on. So that's putting upward pressure in terms of demand. Another interesting one, I think, just to look at it in a historical context, is the size of households. When you look back here to the 1960s, we had about 4 people per household. That has been trending down very sharply, as you can see, down in 2011 to about 2.5 or so, and it ticked up a little bit in 2016. I think this one is interesting as well. Part of that tick up is to do with the fact that the boomerang generation. So people that have been moving home in order to save a deposit to purchase, and that's census data. So it's coming through very strongly in that. But the overall picture, we're moving kind of in terms of our household size. We're becoming smaller, meaning we require more units. So demand picking up from that source as well. We mentioned on the policy issues around macroprudential rules, Help to Buy schemes, and I appreciate that there's a whole range of other policy measures as well that have come into play. The upshot of all of this is that we are in a situation where supply is not equal to demand. So for economists, it's a classic case of economics 101, disequilibrium in the market. How does that play out? It plays out in terms of rising house prices. They have been increasing in Dublin, outside of Dublin, nationally, up around 13% in terms of the latest data. But notably, they are still off their previous peak, so still around 20% below where they were at the peak. If we look ahead and at expectations, and this would be our monthly survey data where we're asking households their views on house prices, plugging that into a series, you can see it's been trending upwards. The standard number is 4 and 5 think house prices are going to increase in the next 12 months. So it's trend very firmly upwards. And not surprisingly, reflecting everything that's happening, more and more people are thinking it's a good time to sell. Less people are thinking it's a good time to buy. So you can see the lines, one moving up, one moving down. The rental market has also obviously been hit as a result of all of this, and we've seen that rents have been rising strongly as well in recent years. Though they, unlike house prices, they are above their previous peak. They're well above their previous peak. And that's led to a situation where around 70% of people think it is cheaper to buy a house than it is to rent in their area because of this issue. Okay, so that's a brief run through of the housing market. I'll briefly touch on a couple of business issues. For businesses, one of the key things that we look at from an economic perspective is investment, and our firms investing, what's happening there. This is a summation of the overall investment picture back to 2007 up to the most recent data. And you see the same sort of trends. This big jump here is obviously affected by the globalization effects, the intellectual property, the aircraft leasing, all of those things that we know about. But if we pull those out, you see a still positive picture here where there's an upward trend in terms of investment. Our business sentiment indicator then, so how are businesses on the ground at this point in time feeling? Going back to 2016, softness in 2016, the dip following the referendum result, the dip following the outcome of the US election, kind of flatlined for a bit, kind of soft enough, and has ticked up a little bit at the beginning of this year. There's been some improvement in it. If we look behind those numbers, what is coming through in the latest data is that around half of all firms, all those guys in red there across the 4 different sectors, are telling us that they think their activity is going to improve in the next 3 months. So they're positive about the near-term outlook for their business. The guys in peach there, for example, think things are going to get worse. So on balance, people are much more positive than they are negative about it. You can have a look at the hiring intentions and where that sits. And again, it's a similar picture. In industry and services, about 20% of firms saying they're going to hire in the next 3 months. In construction, noticeably, that's about 30%. So much stronger there. There's obviously the shortages and so on, and the need for labour. And putting it very bluntly, a lot more firms are looking to hire than are looking to fire over the next period of time. We mentioned Brexit, and Brexit has been a common theme running through all this sentiment data for the last year and a half or so. It has taken a toll on businesses in particular. You know, it has weighed down a little bit their thinking. And we ask them a question a couple of times a year around what impact it's having on their investment plans. Is it having none? Are they putting their plans on hold? And typically you'd find that in economic theory, that when you have a situation where firms don't know what's going on, and there's a lack of clarity, it's a case of, okay, I'm just going to sit back, wait and see, adopt a wait and see approach, see how things play out before making a decision. So that has been happening. We saw in March of last year about 53% of firms, and the guys in red there, were on hold. That has fallen a little bit now in the most recent data. It's down to 44%. So it is early days, but it does suggest that firms are maybe getting a little bit more to grips with Brexit, or becoming less of deers in the headlight phase, I would say. So given that I am running over time, I am just going to very quickly sum up and say, in terms of the business picture, there has been a little bit of softness in sentiment. Some of that is related to Brexit, but underlying it, there is strong activity. And if we look further out over the next 1 to 3 years, what we are seeing is about 2 and 3 firms are ambitious. They're on a growth trajectory. They're looking to expand their business. And that applies to construction firms as well as to the other sectors. So I will pause and just sum up by saying, if you're looking at the Irish economy, it is powering on. Growth is doing well, it is strong. A lot of the indicators are above their previous peak, and the ones that aren't are heading in that direction. So it is quite a strong environment in which to be operating over the next period of time. Not to say that there are not risks. There are a range of risks, everything from political uncertainty to Brexit to the tax environment, infrastructure, debt and so on. They are all in the mix, but notwithstanding those or putting those aside, the economy is firmly back on its feet. So before I get kicked off the stage, I'll pause. Thank you.